Hi, everyone. I'm Thomas.
I'm Taylor. That is pretty loud.
Very glad that Nevin and Tom have taken everyone into great gory detail into the problem that we're trying to solve today, and that's inflation. So now, what exactly is this thing that we're launching? What is this protocol that we've all been talking about that we're getting ready to launch to Ethereum mainnet today? What is a platform for anyone to permissionlessly deploy a asset-backed, fully collateralized, yield-bearing, besides a bunch of jumbled buzzwords? Well, we're about to walk you through that. So before jumping too deeply into functionality, we'd like to first take you all through a bit about the principles that influenced our decision-making over the last couple years. Number one, spending power preservation, inflation. Number two, longevity. We're trying to build something for the next 50 to 100 years, and maybe even longer. And lastly, permissionless and decentralized. I'm very glad that I'm getting the word permissionless out today because that thing always messes me up. Let's dive in. So number one, spending power preservation. The team explored quite a few different designs here. We explored rebasing tokens, distributing dividends, claiming income over time. How do we keep up with this inflation thing? We arrived on appreciating stablecoins that are ERC20 tokens. We'll go into a bit more on this later. But at the end of the day, this one unit of currency should maintain its spending power over time. And this thing should get more and more valuable. It should be easily moved around different blockchains, different places. It should be accessible on in DeFi and CeFi, on an exchange, whatever that is. It should maintain its properties and move around. Another thing, so volatility happens. We just saw a bunch of graphs, which asset prices going up and down over time. We don't think that is something that people should have to worry about too much. But things break, and Saver's purchasing power should not. Lastly, on spending power preservation, no algorithmic designs here. We're going to have 100% exogenous collateral for the one-on-one mint and redeem function. And so that's really, really important. We think that the algorithmic designs are too dangerous, and so we very explicitly avoided that. For our second design principle, we have longevity. We're trying to design something for the next 50 to 100 years, maybe 1,000 years. And it's critical that as the world changes, as asset classes rise and fall, as that portfolio that Tom was talking about earlier adjusts, we want to make sure that our reserve currency can adjust as well. And so we design things for the long term, and to do that, it's all about flexibility. As adjustments need to get made, governance can update those, the way that the collateral is allocated over time. Another key on longevity is safety. Safety is the number one thing. When people are saving money, it is absolutely critical that their money does not evaporate. And so people need to be able to trust this. We went through tons of audits and a very, very intense testing process to make sure that when we hit the button and around 45 minutes to an hour, that big metaphorical button that Taylor's excited to hit, we're feeling really good about what we launched, and we're feeling very good that we got all of the kinks out. Obviously, we will continue to test and make sure that things are safe, but this was a key point of the design process. Testing was a massive, massive piece of it.
Yeah, and just to give some more examples on the kinds of decisions that we made that we think were necessary. So probably the most famous instance of this is our transition from our initial protocol design, our white paper, which was actually closer to the Frax design. So this is actually something that's partially endogenously collateralized. And I think people are familiar with our journey over time to the conclusion that actually we just couldn't justify that as being safe in all circumstances. So I'd say one instance here is we moved from a model that was eventually going to be something like 70% collateralized in the long term to something that is 100% collateralized for all time. And to the degree that we do have endogenous collateral, that is over-collateralization, right? The other two that I point towards, maybe this one's not so fun, but from a design perspective, it's really important. If there is a collateral default and you have a temporary depegging of the R token, there's a question of should you try to defend the price that the R token was previously at? The downside of this is if everyone comes to the protocol and tries to redeem, that you end up with sort of people who are stuck holding the bag. They're holding their R token, and eventually there's no collateral left to redeem. The way to solve this is you just do a pro rata redemption at all times. So basically everyone gets the share of the backing corresponding to their share of the R token supply. This means that in the event of a default, you actually have an incentive to wait if you want the most money. Those who panic and redeem it first are most likely going to get the lowest value, whereas those who wait will probably, hopefully, if everything is working as it's supposed to, be made whole. And then final instance here, I think everyone's seen the DeFi hacks that are too commonplace nowadays. We're cognizant of this, and we implemented something called a redemption throttle. This is hopefully very lightweight, something that people would not notice under normal operating circumstances. But in the case of something like a hack, this could really matter. So this is something like, maybe you should only allow 10% of the supply to be redeemed per hour. So just an example of some of the safety mechanisms that we went with that we thought were necessary.
So lastly on longevity, one of the things that I love about working with the reserve team is just how ridiculously smart everyone is. It's been an amazing time getting to work with this team. But no one is perfect, no one can predict the future, and no one can perfectly forecast what's coming. And so we design with that in mind. So many of the key components of the system are very modular. Governance can be upgraded. We'll go way more into that in a couple minutes. Collateral plugins can be added. We're actually launching a Gitcoin hackathon in a couple weeks where we're encouraging folks to build tons of new collateral plugins and create tons of Legos for DeFi financial engineers to deploy our tokens with. Very exciting. Lastly, trading mechanisms can be added. Right now we're using Gnosis safe auctions, or rather Gnosis auctions, but who knows? Uniswap v7, it's coming. We don't know when it's going to get here, but we might want to use it.
TWAMs, time-weighted automated market makers. Very exciting.
DeFi jokes, getting some laughs, woo. So lastly, permissionless and decentralized. This is key. The world is moving more and more towards transparency, and we believe that this is really important. There's less happening behind closed doors. More and more things are happening on-chain. And we think that one of the key things that governs our lives, money, should operate under the same principles. So we believe that our protocol and the transparency that DeFi and DeFi on Ethereum in particular bring to the world improves on the situation substantially, which we're really excited about. So Nevin's going to go a bit more on this later. And this is a bit nuanced, so Matt Gertler, please pay attention here. But we spent a lot of time designing so that our tokens launched on our platforms are not always securities. Some will have centralized governance. Some certain collateral types will certainly be securities. But the default basic R tokens, many of which we'll talk about today, will not be securities. And that's critical in today's world because currency is useful when it's used. And at the end of the day, it is much easier to use non-securities. And so a key component to all of this is that decentralization is key to adoption. And so it's been a big piece of our design process. If this is going to be a platform that enables the creation of currencies that people use regularly for the next 1,000 years, it might happen. There can't be bank runs. There can't be, people can't be worried that the underlying collateral won't be available for them when they go to get it. The bank is always open, at least within a couple Ethereum blocks. And we spent a lot of time thinking about this and balancing this with safety, which was actually really hard. It was really hard to make this work and make it good for all of the users and all the various constituents, but to still function in a way that is safe and effective. We think we found the right balance, though.
Just to provide some examples for people. If you compare to like central bank monetary policy, this is something that's entirely opaque, right? We spend all our time guessing what's going to happen next. And it's highly permissioned. You have this group of elites who are able to decide, when the money printer goes on. If you compare to something like Terra, it's like, well, it's a little bit better. you have transparent monetary policy, you have a smart contract telling you exactly how it works, but you have a similar group of elites sitting there being the only ones able to do issuance and redemption against the smart contracts. So we think both these are bad. So we're going with an approach that is totally transparent, monetary policy that executes reliably in a way that you expect, and permissionless so that anyone can do issuance and redemption.
So this permissionless aspect is absolutely critical for us. We don't know how wealth should be stored. We have some hypotheses. Tom shared a really interesting example from earlier. But what assets should back currencies for the long term, for wealth preservation, wealth creation, et cetera? We don't know. But we are capitalists and technologists, and we believe that experimentation and competition is key to finding the right answer. And so there's no better way to increase the rate of experimentation than to make it absolutely permissionless and drive down the levels of friction to do so.
I did want to note this did come with a cost, so we did make this decision. We did not make this decision lightly. The main cost that I see from this is, you're fractionalizing or splitting your liquidity across your different tokens, right? If we had a monolithic stablecoin, we would have more liquidity in general for that stablecoin, sort of all else being equal. But I think, honestly, in the long term, if we end up in something like a power law outcome where one coin is 80% of the TVL, then this is essentially not so much of a big hit, right? We're talking about 4/5 the liquidity that we would have had otherwise. So I think this is not too much of a concern. This was one of the main costs that we were paying attention to.
All right, so the problem is inflation. How do we fight that, and how do we do it today with the tools that are available? As a reminder, in order to beat inflation, theoretically, your appreciation and your revenue added together need to be higher than the rate of inflation. So what does that look like, and how do we create a basket of asset-backed currencies, or foreign asset-backed currency, that could work today? In DeFi today, there are a variety of different tokenized ways to store wealth. There's no tokenized securities, there's no real estate, but there's plenty of things that we can do today with things that are on-chain. What's really magical about this, and with all these things that are on-chain, I won't go, I feel like this crowd probably knows about the great parts of Ethereum and how when something's tokenized, it can be broken down into very small pieces. But what's amazing about that is we can take this portfolio, have it back a currency, and then over time, as it's spent and as it's split up, it can perfectly take that piece of basket and move it around appropriately. And so on the left here, we have a variety of different ways in DeFi today that people can put in their assets, put in their mostly stable coins, and generate revenue, whether that's by lending it to people that want to borrow, whether it's by lending it to, providing liquidity rather, for people to trade with, or by lending it to businesses to fund their growth. On the right, we have some ways to store various different types of assets. There's on-chain gold, there's Bitcoin, and then there's Ethereum. We also have a variety of different fiat currencies. There's there's tons of different types of tokenized dollars in bank accounts, which is actually like treasuries in bank accounts. There's euros, and more currencies are coming online all the time. So how do we harness all that, and how do we put those to work in our protocol? So the protocol that we're launching today is a DeFi factory platform. Similar to Uniswap, how anyone can use the Uniswap protocol to launch a token trading pair and trading pair contract. You will be able to use the Reserve protocol to launch our token and the associated smart contracts that go along with it. When deploying an R token, the deployer is responsible for setting a variety of different governance parameters, how the operations work for managing collateral and monitoring different prices and things of that nature. But from there, you deploy the contracts. Those are all set. They're adjustable over time, but it's all on-chain and then a separate set of contracts. So what are our tokens collateralized with? What are we launching with that people can use today, with the big caveat that what we launched today, folks will, we're going to be testing, and we don't recommend that people use it absolutely immediately unless you are excited to test things out in the DeFi world. But that being said, when these things do go live today, what you'll be able to do is collateralize our tokens with a variety of different things. Compound and Aave in particular are two collateral plugins that we're launching with that will allow folks to take any of the commodities that are, or any of the assets that are deposited into Compound and Aave and put them into an R token. And so when you mint an R token that has been launched, that is when you deposit the collateral that is in the basket, and it will create then the R tokens that are given back to you. Vice versa, you can obviously burn those R tokens and redeem the collateral at any point in time. Like I mentioned, we're launching with Aave and Compound plugins, but this is a very flexible piece of the platform. And so over time, we're hoping that, especially through our Gitcoin hackathon that's coming in 2 weeks, folks are going to build collateral plugins for a variety of other things, like all of the other things that we saw on the last screen, whether that's Uniswap pools, Curve pools, a variety of different other DeFi primitives that allow folks to take assets and generate revenue or maintain their value over time.
At launch, we actually have about 18 collateral assets that we've written, and that includes fiat coin derivatives, USD stablecoin derivatives, Euro stablecoin derivatives, and Bitcoin and wrapped Ether derivatives as well as their pure forms as backups. Okay, so let's talk a little bit how the underlying accounting and economics works. So we have a pretty complicated system. I think some people have heard us throwing these terms around before. We'll talk about a collateral basket. We'll sometimes talk about a reference basket. Other times we'll talk about the target unit and the target basket occasionally. So I'll try to keep this as simple as possible. For every single collateral in the basket, we can describe every single collateral in the basket has these 3 units associated with it and has some token or external currency for each of their values. And that might mean, in the case of a boring pure stablecoin, something like USDC is both the collateral and the reference, whereas the target would be USD. So that's sort of how you describe this simple, the case that we're used to in most stablecoin designs within this framework. Our block-by-block accounting, so sort of how the protocol figures out, have I got more than I did previously? Do I have revenue? That has to do with the exchange rate between the collateral and the reference. So in this case, I'm going to walk through this with CUSDC as an example. So for those not super familiar with this is a compound derivative on the stablecoin USDC. It is intended to have a monotonically increasing exchange rate to USDC. So that means sort of at genesis of Compound, 1 CUSDC was 1 USDC. Over time, 1 CUSDC becomes worth 1.01 USDC, and so on. And this is actually a hard invariant in their contracts. Basically, if their contracts are coded correctly, this should never be false. So this is where you get our first round of default checks. Our first way that we can flag that some collateral token has an issue, and we need to quickly, before governance can act, migrate to a backup basket. The second exchange rate between USDC and USD is a little fuzzier. So basically what this is a tokenization redeemability check on the USDC. So it's not really the case that block by block we're calculating the total USD value of all of the collateral. And the reason for that is, well, USDC or any other stablecoin has minor movements around $1, right? So if we were going to honor those, the protocol would sort of always be chasing those movements. So what we do instead is we have this like on a longer timescale process under which we could identify that the reference token seems like it's no longer redeemable for 1 unit of the target token. Kind of parameters we're talking about at the moment, and obviously you can change this. This has to do with the collateral plugin parameterization. A sustained deviation of 5% for more than 24 hours is enough in our currently deployed, or the plugins that we'll deploy later today, contracts in order to delist a collateral. And I'll talk more about exactly what happens when you delist a collateral and switch to backups later. So, okay, so just to hit the high-level points here again, the first exchange rate between CUSDC to USDC is our block-by-block accounting. And this encodes, you can encode a DeFi invariant that's just a function of whatever the DeFi protocol is that you're using the collateral from. And then there is a much longer timescale USDC to USD exchange rate that we monitor. And if it's something like, 1 USDC is worth 94 cents for 24 hours, that's a good sign that all the collateral that have USDC as a reference should be delisted. Here we have, okay, so on the left we have the supply of R token that is circulating. And on the right, we have the collateral backing behind that R token. And you can sort of pretend that at time t0, you don't have that revenue layer, right? Everything is just one-to-one backed. But over time, as there is appreciation of the collateral, this creates revenue, right? It basically opens up some collateral tokens to be used for other purposes, because you now have fewer, you can now back the outstanding supply of our token with fewer collateral tokens. So here we have three destinations, really three classes of destinations to talk about. In this case, where there's 10 cents of revenue, depending on how the R token is parameterized, and this is up to governance, some amount of that could get sent over to the STRSR pools. This is for RSR stakers, the thing that they're interested in interacting with. Secondly, you have a potential stream towards R token holders. So R token holders can see some portion of the revenue themselves, and this is configurable per R token. And we expect people to experiment with different options. There are different appeals here. You can actually pass on none of the revenue to R token holders. Finally, at the deployment of an R token, you can and ongoingly, you can specify any number of arbitrary ETH addresses that should also receive some portion of this revenue. This is interesting because it means there's some incentive, or at least it's interesting for people to come to the protocol and deploy an R token they could potentially benefit from in the future. This is pretty different from Uniswap, where it doesn't matter who deploys the we should clarify here. Governance can also expand the arbitrary ETH addresses themselves, so it's not just the deployer.
One more thing here. So what's really interesting about this flexibility is that this revenue can fund a variety of different things. And we're excited to see how people really play around with programmable money. That arbitrary ETH address, it can be a wallet. It can also, of a company, for instance. It could also be a smart contract. It could be a charity contract that people vote where their portion of revenue goes, kind of like Amazon Smile. It could be a lottery contract where, every week it distributes it to a random chosen token holder. The programmable money thing is like really, really interesting, and we're super excited to see what people build here.
Okay, so first we're going to try to walk through how value moves through the protocol, abstracting away sort of the form that value is held in any particular moment, because that's going to be the easiest way to first understand it. Then we'll talk about how tokens get converted to other tokens and so on. So here as a user, I can go to the protocol, go to the R token contract, and without interacting with any other human, I can call the mint function or issue function. There's some delay, which I'll share the justification for later, hopefully. But over time, that collateral that I put down is moved into the backing manager. This is essentially our main vault. This is where the backing for the R token is going to be held. Once the collateral is held in the backing manager and appreciation occurs, so again, in the compound USDC case, this is just time passing, causes the CUSDC to be worth more USDC. That allows us to take some of that CUSDC and send it to any of these three destinations: the furnace, the set of arbitrary addresses that are beneficiaries, and the STRSR staking pool. We have these two concepts called melting and the drip rate, I guess. We're still working on figuring out exactly what that is. But the way, the high-level version of this is basically that there's a way to smooth out the increase in the exchange rate over time from this revenue. So this revenue essentially will get handed to our token holders in the case of the furnace, and stakers in the case of STRSR over time for the next fairly significant period of time in the future. And this basically allows you to, if you sort of imagine you have like multiple revenue events in the past, this allows you to get a really smooth curve so that this is important for preventing MEV bots from sniping all your revenue. That's what I'll say there.
It also it prevents a variety of different like game theory scenarios where people are trying to like stake and unstake and figure out the most optimal way. It makes it so that the best way to do this is probably just to stay static and like choose a strategy and stick with it. Similarly to an unstaking delay, which we also have for the staked RSR pools, it just prevents this gamification and makes it more predictable for the everyday normal user.
Okay, so now we're actually looking at basically the exact same diagram, but we've expanded it a bit to show the three different locations that capital can actually hang out in. Before, we were just talking about the backing manager and the two traders. Here, we're drawing them apart. And we have this idea of the token actually being traded out within these traders. So you have these like input tokens. So here, I noticed we actually don't have the legend. We lost that here. That's unfortunate. Okay. So these green lines coming out from the backing manager to the traders is excess revenue in the form of the underlying collateral tokens that appreciated, okay? So in the CUSDC case, this is just, okay, let's take some CUSDC and send it along to the traders. Once the traders receive this collateral token, then they're going to trade it into the kind of token that they're interested in gathering. So on the R token trader side, that means they're going to buy R token from the market. So we're basically going to buy back from the market using this single collateral token some amount of R token, and then we're going to burn that, okay? And then all of the backing that sort of you were entitled to by that R token, we're then going to share with all the R token holders, pro rata. And this basically allows, it's a clever way to increase the exchange rate between R tokens and the underlying basket units, which is how we do the fundamental accounting. On the other side, obviously, STRSR, people want RSR to be deposited into that staking pool, so the RSR trader would trade the collateral token for RSR. There is another case here to think about. So in the case where you actually have like what we would call like perfectly evenly distributed appreciation, so imagine you had two collateral tokens like CUSDC and AUSDC, and for some reason they just have the exact same growth rate over time. In that case, you can actually do this trick where you can actually mint more R token. And this is basically, this is quite similar to taking the collateral and marking that as excess, except you sort of do this internal accounting trick in order to create more R token and then sell that to the markets. This is actually more efficient in the case of the tokens ending up in the furnace because no interaction with the market has to occur. The backing manager says, I can create more R token without any cost. I can send to the R token trader, and then it goes right to the furnace. So this is sort of the most efficient way for the capital to flow around the system. In the RSR trader case, the R token is going to be traded for RSR. That's still going to be better, and that's going to be because we expect there to be substantial liquidity between RSR and R tokens, whereas there's probably going to be less between RSR and the underlying collateral tokens. And then final thing to mention here, we can also capture emissions from other projects. So Compound, for example, just by holding a CUSDC token, you earn the right to claim some amount of comp tokens. This is their governance token in their protocol. Through this exact same flow that I described, you can basically have the backing manager end up with these comp tokens. This is an extra revenue source. And then we can monetize that by sending that to traders and selling it for the things we're interested in. So that was the good case. That was when things appreciate. But it's not always so rosy. And in fact, you kind of have to spend most of your time thinking about what to do when it's not so rosy. The rosy case is actually easier. Let's say we have 100 million R token circulating, and this is backed at the beginning by $100 million, right? I don't know what the staking pool would look like there, but let's just guess would be something like $20 million on top of that. So you have $120 million of backing for the 100 million R tokens outstanding. You're over collateralized, right? And from like a finance perspective, the RSR stakers in this case, that 20 million, that is going to be the junior tranche. So they're going to take the loss first before the R token holders. And the R token holder is going to be the senior tranche. They're going to be protected at all cost. So here, let's pretend we had a default of, in this case, USDT, okay? So Tether, some people have gripes about Tether. Let's suppose that it's trading at 90 cents on markets one day, right? And that happens for 24 hours. So what does that mean about CUSDT, right? CUSDT sort of inherits that loss. So the $50 million that we ideally would have had is actually only worth $45 million, right? This creates some deficit that we need to make up. So what's going to happen first, the very first thing we're going to do, is the protocol, after it detects that the USDT needs to be traded out, it's going to decide on the backup collateral. And it does this all autonomously of its own accord. Part of the parameterization configuration of our token is setting up this backup logic. So here, let's just imagine that the backup logic was for a default of a USD-based collateral, we want to back up to 3 tokens, and we have some sort of preference ordering between these, right? So USDC, USDP, BUSD, and there's some other long tail, but we don't need to look at that because all 3 of these tokens are holding their peg. So the first thing is the protocol updates its basket and says, I'm no longer trying to hold equal parts CUSDC and CUSDT. I'm trying to hold 50 million of CUSDC, and then breaking that 45 million into 15 million chunks of USDC, USDP, and BUSD. I should note these backups could be C tokens themselves. Here I'm going to do the pure stablecoins to keep it a bit simpler. That leaves, even after all that CUSDT has been traded out to the market, that still leaves some deficit in the vault that we need to make up. So the next step is we seize some RSR from the staking pool, and you can sort of visually imagine moving over that chunk and attaching it to the right side of this graph. And we would use that RSR to buy 1.66 million of each of these stablecoins we're interested in, the USDC, USDP, and BUSD. So we would get to that final state, and this would sort of be the protocol post default and recovery.
All right. So we've been talking a lot about, well, governance sets that. Governance is going to be in charge of that. Governance is responsible for that. What does that actually mean? What is an R token's governance, and how is that going to work? So functionally, every R token has an owner address. Technically, this owner address can be set to anything. It can be set to a normal Ethereum wallet. It can be set to a multi-sig. It could be set to a typical Compound Bravo governor with a arbitrary token. But as we mentioned in our design principles, we do believe that longevity is really important, and so we thought quite a bit about how can we design something that's going to work into the future. So what is governance actually responsible for in the reserve ecosystem? There's two primary economic things that are actually really, really important. We've been talking a lot about the collateral baskets. At the end of the day, governance is responsible for setting that basket. What are the assets that should be backing this currency? That's absolutely critical. It's like the number one thing, and it's almost like the whole thing driving this project, right? Like, how do we back the currency? What is behind it? The second thing is distribution of yield. So at the onset and also on an ongoing basis, they have to continually evaluate where does this yield go? Does it go to, does 30% of it, for instance, go to the governance pool? Does 60% of it go to the R token holders? Does 10% go to the person that deployed it? Or do we think that they are no longer doing the duty that they said they would do, and we decide that they should actually no longer get paid for their work? This ongoing continuous decision-making around the distribution of yield is actually quite important. What else is it responsible for? So the governor is also responsible for some more specific parameters. Taylor's been mentioning some of these. This and all the other things that we've been going through, by the way, will be extensively documented on our website, to be very clear.
You mean are extensively documented?
Are extensively documented. I believe we actually launched it today.
That was a joke.
They are also responsible for ongoing plugin upgrades and additions. Do we want to change that trader to the new model that has been developed? Do we want to add a new collateral plugin that has been developed and audited, et cetera? The governors are the ones that actually decide that. Additionally, there's a variety of different roles that are going on within the protocol. Various folks can pause things, various folks can freeze things, are able to access particular functions, and the governors also define that. Lastly, this is actually important, and I want to zoom in on it, they define the mandate. So what is an R token's mandate? A mandate describes what the goals are that the governors should be trying to achieve. It's kind of like the Constitution for the legislature of the US, not quite, but it is succinctly explaining what is the purpose and what do people think that they're getting when they get this thing. It's supposed to provide a framework for decision making. And this is something that we actually, we want people to put a lot of effort into this. We want people to put a lot of thought into writing this and making sure that it's very clear, easily interpretable in the future as future governors are coming into the ecosystem and making decisions. This should be something that should be long-lived. It should be on-chain. We'll be writing it to a long-lived place on-chain. And it should be continuing to influence that decision-making.
Just to point to one problem that arises, if you watch the MakerDAO ecosystem and their governance deliberations, they spend the majority of their time essentially engaged in like an ideological intra-battle between different tribes in Maker who think that they should go different directions. If they had something like this, they'd be able to spend less of their time fighting about that because they'd already decided on that. And if you disagree, then that's fine. You go make a new R token.
So some examples, like what might this mandate look like? One would be capital preservation first, spending power preservation second, and permissionless access third. So like what are the decisions that would be influencing, and how might that actually help the governors make decisions? Well, they might choose safer collateral baskets that have lower yield because they're less worried about spending power preservation than they are about the capital preservation. Again, one specific example, we don't know if this mandate in particular will be a mandate for an R token. These are just examples, but these are the types of things, this is the type of level of description and order of priorities that we hope that the mandate writers will be giving to governors and future governors. So why is this hard? You know, the things that we've been talking about at the end of the day require a lot of deep technical knowledge, not just from a technology perspective, but also from a financial perspective. You know, there's tons and tons of people around the world that are thinking about asset management, and you know, these are like sometimes certified, but definitely like professionals that are making these decisions. And at the end of the day, that is something that we need the governors to be able to do. They need to be able to act on this deep knowledge. They also need to think quite a bit about bad actors. Go into this more in a bit, but you need to be very careful about the types of parameters that you're setting and the types of things that you're allowing folks to do, because you know, things settle immediately on chain, and once something's stolen, it's hard to get back in the Ethereum world. And so it's very, very critical that these governors are thinking about game theory, are thinking about the different ways that the system could be exploited and preventing that. And lastly, there's different economic interests. There's different stakeholders and constituents in this system that all need to be considered in the decision making. You know, we've been describing the staked RSR holders as well as the R token holders. Like, at the end of the day, those incentives are aligned, but not perfectly aligned. And we need to make sure that governance is thinking about all those different stakeholders as they are making various decisions. And lastly, how do they make these decisions in a transparent way? You know, this is, again, one of our design principles. How do we make sure that folks can see what's happening, that these decisions are, you know, considered in a public forum and everyone has access to see them? These are all like very, very difficult things that we've been considering with our token governance.
So we will be launching with a broken system, at least that's the way we think about it. It will work for now, but we're definitely intending to improve it, or at least put a good degree of our focus moving forward on improving this system. So why is this system broken? If you've been in the Ethereum system for a while, you've probably heard a lot of this. Vitalik likes to talk about this. But just to break this out for everybody from first principles, the issue at hand is you have a free rider problem in regard to the returns from voting well. Right? If I am like a really aligned, interested, motivated person, and I put a lot of thought into casting the right vote, there's going to be, and let's suppose I don't have a lot of money, okay? I'm like 0.1% of the supply or less, then I'm going to capture 0.1% of the return from that decision, right? So people might be motivated by sort of their ideological commitments or social ties, but in terms of actually being motivated from like a profit maximizing perspective, we should expect people who are not whales to basically opt out of governance entirely. And this is basically what we see in other governance systems. Again, talking about MakerDAO, the last figure I saw for MakerDAO was like they average around 3% participation in most of their votes. So that gives you a sense of like once you've had a protocol around for a really long period of time, and people, you know, it's a repeated game where people have seen what has happened in the past. They know that, okay, it's not really worth it for me to vote. I don't own enough tokens. It's really hard to figure out what to do anyway. And this leads to plutocracy. This leads to a few whales who make the decisions for everybody because they can capture a greater share of the returns from their voting than other people who own a smaller share of the supply are able to. When the TVL is greater than the governance token market cap, then you end up in this instance where sort of if someone could do, you know, a very slow buy-up of all the governance token on the market cap, they could launch this surprise attack where they try to take all the TVL in the protocol. Yeah, there's more. We have an article that describes more exactly how this works. But basically, we expect that the governance token market cap probably will be less than TVL in many cases. And I should clarify, when I say governance token market cap, I'm actually not talking about RSR. I'm talking about the amount of RSR in the STRSR contract associated with that R token, right? So each R token is sort of its own island in this way. And lastly, capital is not expertise. It's really not. This is if you use capital as the signal, that's sort of the thing that you use to intensify, to know that someone is saying something that you should respect more, then you are basically going to slightly diverge from the thing you actually care about, in fact. And this becomes a noisy signal. You basically have like people who can compete and cancel each other out, and you sort of get like no signal at all emerges from the thing, or you have these cartels who are entirely aligned and they come in and they're just, they're very motivated in trying to pursue a particular outcome that may or may not be good.
All right. So introducing what we are launching the protocol with to start, which is Governor Alexios. For those that don't know, I know that most of you probably know who Alexios is, but for those that don't immediately know who that is, Alexios was an 11th century Byzantine emperor who is famous for fixing their currency. When the gold at the time was drastically diluted, he rebased, basically, all of the currency and reminted it and made it much more solid and fixed the economy. And so I'll let you all speculate on why you thought that, or why we think that that was a good name.
So with the context here that we understand that naive token voting is broken, and the broader crypto ecosystem does as well, and the desire to launch quickly, there was a question of how could we adapt an existing ecosystem that wouldn't require us to write a whole new set of code that has to get audited by various firms and so on in order to do token voting. And the answer to that is there's one governor contract in the crypto ecosystem that is used very heavily, opens up in governor. This is a sophistication of the compound Bravo system. It's basically more efficient, more gas efficient. And the main hurdle there in using this off-the-shelf system is that RSR is staked across multiple R tokens, right? And what this means is sort of imagine you have these like long tail R tokens that don't have too much capital inside them. You could have these RSR whales come along and stake a surprising amount of RSR, almost like an irrationally large amount, given the cash size of the cash flow associated with that R token, and then they could try to steal the backing associated with that R token. So this is a pretty different problem that you don't have in a normal like monolithic system with a single governance token with a fixed supply.
So how do you do that? How do we counteract these economic governance attacks? You give a limited protective power for the system to a trusted group. And we'll go into a bit more about what that exactly means.
So we have I just want to start by saying, actually we're going to talk about pausing, short freezing, long freezing, vetoing proposals. Was that 4? I think that's 4 things. Each of these is actually individually settable. But to make this easier to think about, let's just talk about this from like the perspective of there's 2 types of people or persons or groups that we expect to take on these roles. So one, we have something called the Guardian. The Guardian is should be assigned to an address that can be assumed to be highly trusted, and it's okay if this address is slow to act, right? So at the beginning, this will likely be the reserve multisig, and we're looking to add more people from the broader DeFi community who might have high reputation to the multisig. And the second role here is a much faster acting, lower trust role, the pauser role. So the pauser can pause the system, which, what does that mean? Okay, we don't want to pause whole smart contract systems. So what does that mean? Really, it just means we're going to pause issuance and we're going to pause trading, right? So we're actually going to keep redemption open because it's really important that people can redeem. And we're going to hold off on trading because that's one of like the major ways that things can go wrong. Short freezing, similar to pausing, but actually has a finite life cycle. So, and it's slightly stronger than pausing. The short freeze is also going to turn off redemption. And we understand this comes at really high cost, to be clear. But the fact that it's a finite duration means that as an R token holder, if you see this happening, because there's some moment of uncertainty, you can actually be pretty confident that if you wait 3 days or a week, depending on the parameterization, that you will then have redemption capability again. And if you want to sell, you can always sell on the market to a market maker who is going to be thinking pretty hard about the odds that they're going to be able to sell their R token. So, they may charge you some sort of premium, but you are always able to sell in the open market regardless.
So if you do choose to use Governor Alexios, which I want to repeat, it is an option. The deployer that launches an R token can choose to use something else. But if you do choose to use the Governor Alexios, then we think that these Guardian and Pauser roles will actually make the system be able to prevent the issues that Taylor went into. Some of those naive token voting issues, we really do believe that the Guardian and the Pauser mitigate those roles. Otherwise, it will function just as everyone is probably used to in DeFi. When you stake RSR into the staked RSR contract on a particular R token, there will be proposals. People will vote on those proposals, one token, one vote, etc. But in the case where things go wrong, in the case where there may be malicious proposals, or where someone is just literally trying to steal the money, or where there is a governance attack, where someone moves a large stake of RSR from a big market cap R token to a small market cap R token, and essentially takes over that governance, we do think that a guardian or a pauser can step in and prevent the downsides of these issues. And so, while there is at the end of the day, the guardian is a multi-sig for now, and there is a bit of centralization for that. We want to be very clear that that is a trade-off here. There is a bit of centralization. We are trusting a small group of people to do a very good job and to act in a way that the system trusts and will be good for all the constituents. But we do believe that this guardian role is a great mitigation for the short term. Over the next couple years, as we continue to think about this with the community, with a variety of different groups, which Taylor will go into more, and Nevin's going to go much deeper on later, we think that governance will only evolve. In the next 2 to 3 years, Alexios will be something else. There will be an Alexios V2, or maybe we'll find another Byzantine emperor who fixed their currency another time and name it after that. I don't know if that exists. But you want to jump in here?
Yeah, sure. So I wanted to flag an asymmetry here that happens when the system is frozen. So if you sort of think of these frozen states as there's a lot of uncertainty associated with that particular moment, how do you react to that? What we do is we actually prevent people from unstaking, withdrawing the RSR from the SDRSR contract, but we keep staking enabled. And what this allows you to do is essentially like if there's a malicious party involved, you have trapped them into the system. They can't add more capital from outside, right? Well, they can add more capital, sorry, I should clarify. They can stake more. But they couldn't move the capital they've already allocated to one R token to another R token. What this allows you to do is honest RSR holders can actually sit back and choose to stake and rescue R tokens when they are in this takeover scenario. So coming soon, and when I say soon, I'm not going to say anything more about that. Hopefully the next upgrade to Alexios will be allowing people to vote in any STRSR contract, vote in any governance associated with any R token instance from any other STRSR contract, right? So, maybe I am staked across 2 different R tokens in 2 different STRSR contracts, and some attacker allocates a large amount of capital to one of those contracts in a way that I wasn't expecting. After this upgrade, you would be able to vote against them from all the STRSR contracts. So this sort of gives an asymmetric advantage to the honest parties. And we think this will resolve some of the issues with the early stage Alexios that we have. In the future, I think we're really not sure what this looks like. We're really excited to do the research over the next year or 2 to improve upon this, and we have some really great talent we're working with. Learning a bunch recently.
And so, Taylor started the governance section with saying, we're launching something that's broken. I want to be very clear. We do think that this is going to work. We're very excited about Governor Alexios being a great system for the next 2 to 3 years. This is going to be something that we think can, bring the reserve ecosystem forward and allow it to govern various different R tokens effectively for the next 2 to 3 years. But long term, do we think that naive token voting is the way to govern the reserve currency of trillions of dollars of market cap? Definitely not. And so we're going to continue to research that and figure out what is the way to balance the different powers and what is the way to make that work more effectively. Again, we'll go into this more in a bit this afternoon. But yeah, we're very excited about launching with Governor Alexios.
Yeah, from my perspective, anything's broken if the developers could get hit by a truck and then it would break later.
All right. So we've talked a lot about the nitty-gritty, and I realize we probably went into some arcane detail there. And we did so because, one, we want everyone to really understand how this thing works. Also, there's probably no other group of people in the entire world that would be just as interested in hearing those details. And so we're excited that all of you got to learn more about this today. And we want to continue to engage with this group and with the broader reserve ecosystem, whether that's like in Discord, communicating, debating all these different things, understanding how they work, helping us to update the documentation and make it more understandable for everyone. But as we get going, and as we continue to, or rather, as we start to build the reserve ecosystem out and help it to grow, there's a variety of different incentives that we think over time will help to grow this ecosystem. And I have a note on the slide notes here with a massive caveat from our general counsel that this is a hypothetical situation. It's how we believe it might work out. But this is in no way financial advice. I'm sure there's other caveats that I'm supposed to insert there, but please assume that they are inserted. So how does this thing get going? All right, so we launched today. Taylor and Matt are going to hit this button. There's a protocol. Great. Why would people actually use this thing? We think that it's valuable, et cetera. But what are the incentives for the market cap of our tokens to grow? So for those that are not familiar with Curve and Convex, it's a stablecoin DEX ecosystem that offers very low slippage, but there's also a very complex incentive system, shall I say, going on with their governance, where the governors of the Curve DAO actually decide where the future CRV emissions get directed. And so, without going into too much detail here, we have acquired a bit of Curve governance power through the Convex token. And as a result, we plan to incentivize liquidity of our tokens in Curve trading pools. And so, all right, so we have this protocol. There's some R tokens. People will hopefully be incentivized then to mint these R tokens, take collateral from around the DeFi ecosystem, mint these R tokens, and put them into Curve liquidity pools so that others can trade with it. Once it's there, these incentives will continue to incentivize folks to keep their liquidity there, continue providing that liquidity. As a result, the market cap of an R token or a group of R tokens might continue to grow over time. You'll continue to hear a lot of words like might and may. So we've got this growing market cap. Now all of a sudden there's a variety of different collateral that's locked up in the protocol that's producing yield in a variety of different ways. Okay, great. So what happens then? So the yield is now continuing to grow. All of a sudden, as that yield of the collateral grows, it will incentivize people to stake their RSR because the yield that is going to that RSR pool, the staked RSR pool, might be higher now. And so as the APY on that staked RSR pool has grown a bit, that might incentivize folks to stake their RSR there and grow that the size of that staked RSR pool. And so as that has larger and larger staked RSR backing up the market cap, people might perceive that to be safer. There's more of a backstop in the case of a default. It can withstand more of a shock to the system if some of the underlying assets do depeg. And so that safety continues to attract more collateral, or rather more R tokens into the market cap. And this thing continuously might virtuously grow in that way. And lastly, and this is where it gets really interesting. So we've got, a decently sized market cap at this point. There's tons of different folks that are actively participating in governance. And governance is now thinking about, okay, we've got this great income. How do we actually make this more stable? How do we make this more predictable over time? Typically, when many people want to do that, they want to diversify. They want to find other sources of revenue. And so, with this, we think that people will then go build new collateral plugins and think about how these collateral plugins can fit into a collateral basket of an existing R token. I mentioned this already, but we're launching a Gitcoin hackathon in 2 weeks for folks to build new of these things. We'd love for there to be tons of different Legos for the DeFi financial engineers to think about how they can build optimal R tokens and really create that balance between risk and yield for the different constituents of an R token system. So now that there's more options, there's more diversity in the revenue that's being produced by the collateral. All of a sudden, that's more stabilized, maybe. And with this, potentially more stabilized, more diversified revenue stream, all of a sudden, it's a much more attractive place for folks to hold their RSR and to stake their RSR. And now, lastly, what about this really, really crazy example? So these flywheels have worked to perfection for the next 10 years, who knows how long. Again, massive caveat that this is a ridiculous example and that this probably won't happen and that this is in no way investment advice. But what if an R token had the market cap of gold? Hypothetically, that these flywheels had continued to work to pull more and more assets into the system that people could use and transact with on a daily basis. If that were to happen and the collateral had a 0.89% yield, that would actually be producing a ton of revenue. That would be $1 of revenue for every RSR per year, which is like kind of a wild thing to think about, right? Like as these systems grow and if these flywheels do actually work, it could get to like a kind of wild spot. Again, massive caveats. This is a very, very future situation that probably wouldn't happen. And yeah, so thank you so much for spending some time with us, going through in depth on how the protocol works. I want to give Taylor actually a special shout out. I think he got off a plane like an hour and 15 minutes ago.
Yeah, sorry if I seem like I'm out of it. It's because I am.
But